Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, National Underwriter with Old Capital, Paul Peebles, and joining me today is Les Meisel with Old Capital. Hey, Les.
Hi, Paul. How are you today?
I'm doing great. Before we jump into the interview with Charles Ho that Mike and I did a short time ago, I kind of want to visit with Les about just seeing what's going on in the market today. So I'm going to ask Les, what's going on your desk?
Well, I'm seeing a lot of requests for refinancing for reasons from A to Z, but a lot of refinancing activity.
A lot of refinancing. I know that I had done an acquisition back a little bit less than a year ago on a property over in Irving, and the borrowers bought the property. It had an acquisition with a rehab component to it. They had to rehab the property. It really wasn't stabilized. And I'm going to say less than 10 months, 10, 11 months, less than a year later, they're looking to refinance, pay off that bridge loan that we did. Now, there's no maturity. It had a 5-year maturity. But they're looking to refinance and go to a permanent loan. And so that permanent loan is what Les is working on right now. So tell us a little bit about that transaction, Les.
Well, you're absolutely right. It's been less than a year, and they've used that money to upgrade the property. And right now we're in the middle of getting a loan for them that's a non-recourse loan that also allows them some cash back to reinvest and buy additional buildings.
Wow. So a couple of key points. One, they bought the property less than a year ago. They did a bridge loan on the property, but that didn't have a pending maturity, so they don't have to do anything if they didn't want to. But it was a recourse loan. So their partnership decided that they wanted to get out of the recourse piece. Their numbers looked so good that the new lender coming in wanted to partner up with them and offered them a 30-year amortization, a 10-year term, just like Les said, a non-recourse loan, and pulled a bunch of cash out. So that can't happen all the time, but I thought that was an interesting one to kind of talk a little bit about the podcast. Anything more you wanted to add with that, Les?
No, we have a very happy client.
They did have big smiles on their faces. So with that, let's jump into Charles Ho's podcast for today. Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital Lending, and always joining me, Michael Becker.
Hey, Paul.
Michael, I'm excited to have Charles Ho with us in the podcast today. Charles is going to tell a very interesting story about how he comes out of the IT business and how he got into real estate. And now, as I call him, the king of the car washes. So his background, not only was he in IT, but he also was in single-family rentals, and then he transitioned into multifamily. So we're going to learn a little bit about some of the goods and the bads of being in multifamily real estate, and I want everybody to meet Charles Ho.
Hello, everybody.
Hello, Charles. So I thought we'd just kind of kick it off for, if you could do us a favor, let everybody meet you a little bit. Tell us a little bit about your background, what you did prior to getting into multifamily.
I was in the IT business for quite a few years. Started from, people call it the system administrators, and from there went into overall infrastructure design, managing, and at one point managing a good server farm for a small company in North Dallas. And from there, I always wanted to have my own business and started with a car wash back in 1996. And that somehow grew to a maximum of 8 at one point. And as of today, have a total of 6 car washes on hand. And back in early 2000, started dabbling with the residential real estate and buying single-family homes and rented them out. Didn't have a good business plan, and after a few years, sold them off and concentrated on the car wash business.
One of the things I wanted to bring out in the car wash business is a little bit of what Charles has done, is that Charles is a value-added car wash owner, because what he did, and he saw the opportunity, not only was he washing cars or having cars washed on his property, but Then he put out kind of a secondary business. And this is kind of something that everybody has to kind of think about. Secondary business was a Hawaiian ice store?
It's a shave ice.
Shave ice store. So not only do you offer one product, which is the car wash, Charles was able to see that he could have a second business on the property too. So I think that's a little bit clever, thinking outside the box for a business plan. So tell us a little bit about, you went to single family, you did a little bit of the car washes, now you're into multifamily. Again, how long ago did you get into multifamily?
Got into multifamily in 2011. First joined a local investor group, and from there learned the basics and the nuts and bolts of being a landlord.
What made you want to get into multifamily? What was appealing about it to you?
The predictableness of the income, the overall valuation of the properties, which is pretty much hinged on the income, and by making various improvements outside, you could actually raise the rents, which at the same time increasing the overall valuation of the property.
So good. So you started in 2011. Did you just do exclusively multifamily, or did you get back and do some single-family investing as well?
I did some single families at the beginning just to test the waters again, since I got out of that part, and make sure that the business plan were sound. And once that was tested out, we jump into multifamily both feet.
If you're doing well as a single family, you just too much time, too much effort. What was the decision factor between the two?
Well, it really is the economy of scale. Kind of a quick way to look at this is I can have 50 single family all around town in one city, or I can just simply have one apartment complex with 50 doors at one address. It's a whole lot easier driving to one address and deal with everything I got to do, instead of driving from one house to the other 50 times.
So tell us about the first deal you did. I think you started out by being a passive in someone else's deal. So maybe tell us a little bit about the first apartment complex you guys did.
Well, I got into the multifamily side, joining another lead investor who happened to be putting a deal together for 160 units. And with my build-up net worth, I was able to go in as a key principal and help guarantee the note to make sure the deal goes through.
So key principal is a Fannie Mae term. So it's when you sign what's commonly referred to as a bad boy carve out. So you kind of stand behind to make sure the property's ethically run and will be do the proper financial reporting. So you signed on as a Fannie Mae KP. Why do that versus just invest in the deal passively without signing on as a KP? What was your motivation for signing on as a KP?
Well, knowing I was going to be doing deals on my own, I believe was helpful and beneficial for me to know what the processes are and understand the deal a little bit more. And sure enough, I was able to learn quite a bit through that process.
That's good. So when did you buy that deal?
That was in August 2011.
Okay. And then tell us about the first deal you did on your own. When was that? And tell us a little bit about the deal.
Well, that deal was first tried to be put together back in November 2011. It was an REO. Foreclosure. We lost the deal to another buyer. They were willing to pay almost 20% more than we do. So we basically got away from it. But for one reason or another, the other buyer never came through with it. So it was back on the market. We saw it, jumped on it, and was able to get the deal with just a little bit more than what our original offer.
And when did you close on the deal?
That deal was closed in February 2012.
And so it was called the Viewpoint Apartments, is that right?
Correct.
It was 85 units?
85 units.
That's good. So was that a pretty stabilized property, or was that a value add property? Tell us a little bit about kind of what you walked into.
Oh, it was definitely a value add. The occupancy level was at 61%.
Oh, wow.
And had quite a bit of deferred maintenance that needs to be addressed.
Did you go in self-managing the deal, or did you have a third-party management company? Tell us a little bit about that, and how did you, maybe before you do that, how did you end up financing that deal?
Well, we financed it through a local community bank. Since it was our first try at this, we thought it's probably better we get a third-party management company to do this. And honestly, that's what we thought that we were always going to do with third-party management company, because that way would give me more time to concentrate on the acquisition and the asset management part instead of the actual day-to-day process.
So let's talk a little bit about that. So the property, Viewpoint Apartments, property's over in Irving. And how many guarantors in that transaction?
In that transaction, we had a total of 4 guarantors on it.
And how many other just investors were in that one?
7 of us
Oh,
altogether.
just total 7?
Yes.
Okay. So the guarantors signed their name on the joint and several liability, so it was a recourse loan against the property. Then we also put in some rehab dollars into the loan itself.
Correct.
And then you took over the property and then you started to implement the rehab of the property. And then you found out over a period of time that you thought you could almost do a better job than the management company that you had hired. Is that correct?
Well, the easier ways to look at that was we, as owners, and the management company each have our own philosophy and ideals. We were both trying to build businesses. We were trying to build the owner's business, and the management company was building their management company business. For one reason or another, we are not heading toward the same direction. And because of that, it was best to call it quits.
And that got you into the property management business.
Correct.
And so now you currently manage Viewpoint Apartments yourself and your team that you've kind of put together. And so that property, for everybody to take a look at, is 85 doors, is it?
85 doors.
And it's a flat roof, has mansards, which kind of looks like, how would you describe mansards, Mike?
The roof's on the side of the building, basically. So,
So did you put new roofs on that property?
We sure did. We did TPO overlays, and then on the flat roof, and then we did some new shingles on the side.
And so you took the property over at a low occupancy. Now it's at a high occupancy. What occupancy is it at right now?
Actually, as of today, we're at 98%.
98%. And then just last month or the month before, you refinanced and pulled lots of your cash out.
Correct.
And so on a short-term basis for the last, 2.5, 3 years since you guys have owned the property, what's your rate of return, would you estimate? Any ideas?
Proper math says we're pretty much at 300%.
I like that math. So that's not bad for a property pulling that cash.
what kind of loan did you guys put on when you refied it? So you had the community bank. Did you go back to the same lender, or did you go somewhere else?
We went back to the same lender, and they offered us a second note to pull the excess equity out that we have actually built up because of our better operation. And that money alone, plus a little bit of the distribution we've done in the first 2 years, covered all our initial cash.
That's great.
And leaving approximately $1.2 million equity still.
In the deal.
Yep.
And that's a good deal, because that's rare that the lender would worsen their position through giving you a second lien note. So must have a lot of confidence in you guys. So that's good. So tell us a little bit about. I know you bought another property also in Irving, a water tower, or I don't remember what it was called when you bought it. But tell us a little bit about that deal. When did you buy it? Let's start there.
Well, it was marketed as Parkside Gardens, and during the due diligence process, we realized it really wasn't called Parkside Garden. It was called Piedmont, and the name had been around for 50 years. And then after we took over, we renamed it to Water Tower Villas because there is a water tower right next to the property. So that makes it very easy to identify and find for anybody that needs to know where it is. We put that deal together with approximately 12 investors.
What kind of debt did you get on that deal? Was it you go back to a community bank, or how did you take it down?
Well, actually, we looked at the community bank and went back to the seller and let them know that a lot of the necessary information to put a loan together really wasn't there. So the seller agreed to do a seller finance for us.
Oh, good. That's good. So is that able to lessen your down payment? You remember what leverage you got on the deal?
We actually increased the down payment because during the purchase process, we were supposed to buy the apartments along with another 27 self-storage units. But since the self-storage units were sitting on a property line, encroaching onto another piece of property, we thought that would create an issue. So the seller also agreed to back that out of the transaction. But at the same time, the seller has some debt obligations to pay off, so we simply upped our overall down payment.
Okay, good. Where was that property when you took it over physically? What kind of occupancy and what have you guys done and where are you at today?
Well, I guess depending on the numbers, which number you want to believe. But honestly, we took over at approximately 80% occupancy.
And how many of those guys are actually paying?
Well, the funny thing is everybody was paying. They're just paying different rates and speed. Some were paying almost on a every other day. A few are every other day. Most of them are on weekly basis.
Weekly pay, huh?
They were on weekly pay. When we tried to set up our software, we actually run into trouble because our software didn't know how to do weekly payments.
Yeah. So was that literally in the lease, or was that just some sort of bartering thing that they did with the residents?
That was actually written in the lease when they moved in. But when we took over, there were very few valid current lease.
Okay, everything was expired. And
they were all expired. Everybody was on month-to-month basis.
So where are you today?
We are back up. We had to do a lot of renovations, let some residents go because of conditions in the units and also the below market rates. We had to bump up. And right now, as of today, we are currently at 96% occupancy.
Great. How much were you able to raise rents?
Well, our lowest rent when we took over was $100, all bills paid. So we had to bring those up to the $600 range.
So most of your units are around $600 or so.
Most of them, yep.
That's good. So you weren't done there. I know you recently just closed on another 2 properties, I guess, that were adjacent to each other.
Yes.
So tell us a little bit about that. What did you buy, and tell us a little bit about the Pioneer House.
Well, that was 2 properties adjacent to each other. The seller had been on one for 20 years, the other about 25 years. He wanted to sell them to go to something a little bit larger, better. So we saw the opportunity, seized it. We were the first on property to tour, and we turned in the letter of intent the same day we toured the property.
Good. So it was 146 units in total. How old is the buildings, or when were they built?
These were all late 60, early 70 built.
Okay. Tell us a little bit about the physical condition of the deals. Were they in pretty good shape? A lot for maintenance? Were they 60% occupied like the last deals you guys bought?
No, this one was completely different. It was fairly well maintained. The previous owner did the right thing in lowering the make-ready costs by putting in a lot of ceramic tiles on the floors, and also at the same time did the necessary exterior maintenance to make them, I would call, attractive. But at the same time, there were still few tough cosmetic issues that needs to be addressed.
That's good. So why did you kind of gravitate from some pretty tough, challenging properties up to one that's a little bit more stabilized? Is that just a sign of the times, or was that an intentional thing that you had your fill of the challenging properties and wanted to walk in something a little bit better day one?
Well, I love the stable cash flow, but at the same time, I feel like we can do a good job buying a somewhat distressed property and add some value to it. So benefiting on that front, at the same time, after we did it, we can enjoy all the good cash flow.
So this deal itself, you feel like it's somewhere in the middle where you definitely have some upside in rental rates and...
Correct. This one definitely had below market rent, so we believe we had a lot of room to work with. Even though it was sold to us as a 99% occupied, we believe we can help to improve the property and push the rent up quite a bit.
It's good. So tell us a little bit about how you financed the deal. So did you go back to that same community bank, or what did you end up doing? We
actually went back to the same community bank, and they did a quick analysis on it and recommended that we probably be better off with the agency debt.
So you went and Old Capital helped you get a Fannie Mae loan,
Correct.
Right? So tell us a little bit about the structure of that deal and what did you like about it, and what do you like or don't like compared to the community bank loan?
It definitely was a little bit more attractive on the 10-year term, 30 years amortization, and 4.3% rate.
That's pretty good.
Yeah, but at the same time, these loan documents are tough,
Yeah, cumbersome a little bit.
very cumbersome, and there's no modification whatsoever, so it makes it very difficult.
Sure. But so were you able to get full 80% leverage on the deal?
Not quite. We got, because we have some deferred maintenance issues that has to be budgeted into the deal, so we got somewhere around 72%.
So 2%, but it's fixed for 10 years, and the best part about it is non-recourse versus signing a personal guarantee.
Correct.
That's good. Maybe kind of tell us a little bit from your experience, talking to someone that's new or aspiring and getting the business, maybe some things you learned along the way, some core key things that someone should be taking into consideration when they're thinking about buying an apartment complex.
Well, I think that the first one is definitely what we call define your sandbox. Know what you want to do, figure out what fits your personality and your strength, and go after it. And once you have made that decision, be persistent and stay on top and get it done.
This business is full of education, full of stories. Any funny stories? Anything that people would think that would be funny that you were able to overcome in the acquisition of the property or finding out what you got after you closed? What have you been most shocked on? I know this property that we're currently in, so we're in one of Charles's properties right now, and I remember seeing this property a long time ago. It was in marginal condition. I thought the birds and the cats and the rats were the favorite tenants of this property, and so when Charles bought the property and took it over, and just like he said, his tenant was able to pay $100 a month and stay in the property. That was a challenge. You saw that going into the transaction, but then you also saw the value added of what the other rents were in and around this area, where the marketplace is not $100 a month in rents; it's $700, $800, $900 a month in rent. So, so my question is, why didn't the seller do what you're doing, trying to put Humpty Dumpty back together again?
Well, I guess it has to do with the business plan. We have a business plan that we have put together. We know what we want, and we're able to execute it. The seller inherited the property from family debt, and that I don't believe was something they intended on going. So I don't believe they had a true business plan in place to follow.
How do you find the market is? I mean, looking back the last 4 years, you've done very well. Your partnerships have done very well. I mean, you've gone from being the king of the car washes to being the king of the multifamily in the South Irving area. And I'm sure lots of people are bringing you opportunities and transactions for you to take a look at and see if you want to buy. I mean, what has changed from the period of time of not knowing anything to knowing something right now? Or are you looking to do your next deal? I mean, even though you just bought this property, the executive house property, are you thinking about doing something in the next 6 months?
We're definitely on the lookout for the next opportunity. The key in this business that really makes successful and helped us is building a reliable team. We have a team of employees, vendors that come in to help us make this work. Old Capital is one that continues to bring us the good financing. And at the same time, we have attorneys, CPAs, and also vendors that know what they're doing. And when we call on them, they answer and take care of it.
So how hard or how has the equity raise changed from when you're out there raising money to do the Viewpoint deal to the Pioneer House that you just closed? Is it easier or harder? Maybe kind of talk a little bit about how that's kind of changed for you a little bit.
It definitely made it a little bit easier after you have a bit of a track record. I can remember when we were putting Viewpoint together, we had a small surplus, but when we were trying to do the Pioneer House, their surplus was definitely a lot higher.
So how did you overcome, when you go back 3 years now, how did you overcome the lack of track record to get your first deal done? Was it just mainly through partnering on as a KP on someone else's loan? Was that what got people comfortable with you as giving you the keys to the car? You never driven before. How did that work?
I think it has to do with being true to yourself. Let people know who you really are. A lot of the investors that we have now have pretty much became good friends, and they had invested with me from one property to the next to the next. So that's being extremely helpful. The very last Pioneer House deal that we did, 2/3 of the money came from investors that had invested with me in the past.
Yeah, that's good. Do you have any other kind of parting words of wisdom or anything, someone that's aspiring that wants to get in this business? What would be one of the first things that you would tell someone to do that wants to get into the business?
Get educated. Know what you're getting into.
Yeah, well, that's good. That's good information. Well, Charles, if anyone wants to reach you, if you want to share an email address and let everyone know how to get a hold of you.
Sure. They can email me at C, like Charlie, at abcderealty.com. That's first 5 letters of the alphabet, realty.com.
That's good. Charles, thank you so much.
All right.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.